Good afternoon, this is Sean Golding with Golding & Golding, here to discuss some of the basics of the exit tax calculations, some important tips when you're preparing the Form 8854, just considering whether or not you're subject to it. There's a lot of bad information out there regarding exit tax just because it's kind of complicated and the IRS doesn't make it that clear. Quick background, expatriation is when a U.S. citizen or long-term lawful permanent resident decides that they're going to give up their U.S. status and formally expatriate. Not just moving away or being an expat, but actually going through the formal process of expatriation. It's only for U.S. citizens and long-term lawful permanent residents, which means you've had the green card or permanent resident status for 8 of the last 15 years without filing the 8833 during that time. There are some exceptions and some exclusions and some limitations, but that's the baseline. So the exit tax. The idea behind the exit tax is that if you have certain gains or accrued income that you haven't paid tax on, it's tax deferred, or certain deferred compensation, stocks that have risen in value, other securities, and you haven't paid tax on it, well, guess what? The IRS wants to tax you when you leave if you're a covered expatriate and if you have certain types and categories of income and the exclusion isn't sufficient to avoid. For example, if all you had was stock gain and you had $600,000 of stock gain, well, guess what? You get a $737,000 exclusion, so you wouldn't actually owe any exit tax. Let's go through some of the basics. The most important thing to keep in mind is it's not a wealth tax per se, it's an exit tax. So, example, Michelle has $100 million of cash sitting in her bank account. Good job, Michelle, right? She got $100 million of cash sitting there. She's a covered expatriate, right? Because her net worth is more than $2 million. Is she subject to any exit tax? No. Why? Because if all she has is that cash in the account, there's no Mart-to-Market, there's no deferred compensation, there's no other sort of tax issue. She has a bank account that has cash in it. She's not getting a wealth tax because she has the money, even though she's considered a covered expatriate because of her net worth. There's no other sort of unrecognized gain or income that she has to pay tax on. Okay. Second, a lot of times you hear something about Mart-to-Market, but that's not the only thing. Mart-to-Market. So Jim has a $100,000 basis in stock he purchased when he came here, and now it's worth $4 million, right? So the day before Jim decides to leave, he has to, or the day before he formally expatriates, he has to look at what the phantom, make-believe, made-up tax would be if he uses the fair market value of the stock on the day before he expatriates minus the basis. That's only one type of potential tax consequence at exit. There's also deferred compensation and other types of deemed distributions and things you have to be aware of, okay? For example, if someone has an IRA, okay, it can be deemed distributed the day before expatriation. There's some issues with Roth IRA versus traditional and things like that, but it loses its tax deferred treatment for expatriation purposes, okay? And there's also deferred compensation. You know, if it's US-based deferred compensation, normally you don't get dinged with the exit tax. It's not deemed distributed later down the line. It's a 30% withholding, okay? But if it's ineligible deferred compensation, maybe you have a foreign retirement plan, subject to the step-up basis rules, talk about in a minute, it's deemed distributed. So maybe you have an Australian super or some provident funds, certain retirement plans in other countries. That is deemed distributed the day before you expatriate, and you can't use any of that Mart-to-Market exclusion amount because it's not a Mart-to-Market gain, okay? And again, another important tip is the exclusion amount. So if you have a certain amount of stock gain or other type of property gain that's non-recognized, so it's just sitting there, you bought a house for $500,000, let's just say non-primary residence, and now it's worth $1.5 million. A portion of that gain is going to be excluded when you're doing the calculation, so you don't pay tax on the full amount of the non-recognized or unrecognized gain. Rather, you pay it on just the portion in that exceeds the exclusion amount. A couple of other important tips to keep in mind net worth is not just the asset value. So let's say you have a house that's worth $3 million. Well, now you've just met the net worth test. But let's say you have a 1.5 million mortgage. Well, now your net worth is 1.5 and you wouldn't meet the net worth test. Step-up basis. So the step-up basis stuff is very important, and oftentimes it can save taxpayers from a significant tax consequence. It goes like this. Let's say you owned a property, you bought it for $500,000. Non-U.S. person, no U.S. status, living outside of the U.S. And you come to the U.S. day one, and now it's worth 1.5. Well, you get a step-up basis so that when you expatriate, if it's worth $2 million, let's say, the basis is going to be the 1.5, the fair market value on that day you became a U.S. person, not the day you purchased it before you had any U.S. status. Same thing with pension. There is one complication, which I deal with often, but with pension, it's the same thing. You worked for a foreign company, non-U.S. person status, and you came to the U.S. with $800,000 in pension, and now it's worth 1.4. So the concern is what's going to be considered deemed distributed, and there's two issues. One, you don't have to pay it on the full amount for sure, okay? Because if you come to the U.S. and you earned that foreign pension before you were a U.S. person, that's your step-up basis. So the first day you're a U.S. person, it's worth $800,000. That's your basis. Second, it's gone up to 1.4 million, right? But it's frozen in the sense that if you didn't make any contributions to it after becoming a U.S. person, is that different taxed, right? It's a common issue, and it's something that if that's the situation you're in, you should discuss it with tax professional, get different views on what you can do. And what the tax consequences can be. If you're considering expatriation, it's important to do some analysis, do some planning beforehand. You don't want to be surprised with that when you're sitting there filling out your 8854, and it's something you have to do before the Expatriating Act. You can't go back and unwind that act. So once you filed your I-407 or went into the consulate or embassy and did your DS 4079 to 4083, you can't go back and unwind that. So that's something to keep in mind. We have lots of free information available on our main website, goldinglawyers.com and expatriationattorneys.com. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.